Firstly, let me extend a warm welcome to each one of you. I'm really excited to be here amongst you and to see the overwhelming response to this event is even more special. And I also extend a warm welcome to all of those who are joining online and watching this event. What I'll do in the next 15 minutes is take you through the macros, the economic backdrop for the first 3-4 slides, and then talk about the industry, and then how Federal has fared since the last analyst meet. When I say the last analyst meet, the point of reference, which when I come to the slide I'll mention, is going to be the one which we had in FY20, and then we had the COVID year, and 23, which Ria referred to, was a sort of interim checkpoint to see the progress. So let me move quickly to the slides. So just a quick overview on the macro operating environment. Most of us have been hearing about the economic growth and the conditions which are prevalent today. And there are projections about what the GDP growth for the country would be in FY25 and 26. The numbers range from 7 to 6.7 for next year, and this year it's around 6.3. What we have done is we have anchored to the RBI projections for this purpose. And when we go into the next slide, I'll show you the various institutions, what projections they have given. But we should be clear, or rather we should just be mindful of the fact that yes, there are near-term headwinds. The conditions are not looking as good as it was in the past, but we are reasonably confident that this would play out and the medium-term outlook for India continues to be strong. In terms of the overall industry, the health of the banking industry is relatively much better than what it was 10 years back, both in terms of efficiency and also the capital. Banks have been preparing for the ECL transition and have been strengthening their balance sheets. We have seen some level of consolidation as well in the industry, and we believe that will continue to play out as well, both in the PS, public sector banks, and maybe in the private sector as well. Of course, the near-term threat of tariffs and what is likely to happen to certain industries, sectoral impact will play out. But having said that, there are still pockets where we see opportunities for growth, and how we capitalize on those is what we'll cover later during the session. Private banks reported a PAT growth for the 9 months at 12% YOY. This is up to December. That is Q3 of this FY. And small finance banks obviously had an impact due to the ongoing issues in the microfinance space, largely microfinance space. The declining credit growth is something which we have seen play out. And whilst for the industry, the credit growth was around 12% year on year, for Federal, our year on year credit growth was around 16%. And between sectors, there are variations. On the deposit side, whilst this number which we are saying of 11% growth, that's at an industry level. But you have to peel it and see how is it for public sector banks and private sector banks. And there are a couple of large private sector banks who have grown their deposits faster during this 9 months, mainly because of the CD ratio issues. I'm sure you all know which are the two big banks who have had to grow the deposits faster and slow down on credit growth. Now in this slide, you can look at, from FY23 Q1 onwards, how the economic growth GDP played out and the trajectory of the GDP growth. And obviously last 3 quarters, it's been coming down, which is the reason why there has been a moderation in the full year growth outlook for the country. RBI projections for FY26 is 6.7, and as you can see, various bodies have forecast from 6 to 6.8. We have, like I said, chosen to go with the RBI numbers. But what more important is the graph on the left side bottom, which is on the inflation moderating and showing signs of coming within the band which RBI wants to operate. And of course, we all saw the first rate cut which happened a few weeks back, and alignment towards the band which RBI is expecting to land the inflation numbers. Banking industry is a barometer of the economy. So the slowdown in the economy gets reflected in the slowdown in credit growth vis-a-vis the overall output, and assuming even a 6.7% growth next year with, say, inflation of around 3.5–4%, we are looking at a nominal growth of less than 11%. And we have traditionally seen banks grow around 1.2x of that, and Federal has been relatively better amongst the banking industry growth. So whilst in the last earnings call we said we will target to grow around 1.5 times the nominal GDP. So at this stage, whilst the horizon in the near term is very cloudy and not certain, we do expect by FY26, as the quarters play out, we should start getting more clarity. However, a large part of the capex in the industry has been driven by government so far. We also have to wait and see how much of that is sustained and how much of private capex starts coming into play, because we do need to see capital formation. This slide talks about both the average lending and average deposit rates over a period of time from September 22. I've taken the reference point. There is a line from March 23, and that's when the rate was at 6.5 repo rate and stayed on till about a few weeks back. What is interesting to note is that whilst the lending rate has been relatively flat, the deposit rate, average deposit rates, continue to have gone up and stayed at that levels and continue to be firm. This is also reflective of the tightened liquidity in the market, and we all have been seeing that whilst RBI is trying to take various steps to ease the liquidity, but as we speak and in the near term, we don't expect deposit pricing to soften in a hurry. It will take some more time for the deposit pricing to start reflecting the repo rate cut. On the right side, you can see the percentage of, this is just on the floating rate for the industry, how much percentage is EBLR and how much is MCLR. Whilst there are different views from economists on what the rate cycle would be in the April MPC, at this stage, there's view that there'll be one more rate cut, but we'll have to wait for data to see how it plays out. And then, but since the stance is neutral and the inflations are coming under control, there is all likelihood that we may see one more rate cut happen in April. The next slide, I'll talk about some of the BFSI indicators. The first one on top left is on UPI. The reason why we chose to show this is the pace at which the UPI has kind of grown over the last several years and continues to grow. This also means that the enormous investment which banks are making in the IT infrastructure, we have to keep pace. And what is also happening is, amongst all this, is the number of, and as digital transactions increase and get sophisticated, the digital frauds are also multiplying. And those are things which banks are now looking at how to curtail, curb, spend, or rather put in monitoring tools for that. I'll cover that later in subsequent slides at the later part of the session on what we are doing on this aspect. Mutual fund AUM has been growing steadily. This is an area of opportunity, both mutual fund and insurance space. And why we feel excited about this will get covered in Manian's session when he talks about what are the opportunities we plan to seize in this space. I'll just skip the slide. Yeah, this is an important slide in terms of the industry landscape and regulatory priorities, because each of these have an impact and bearing. Credit deposit growth dynamics. Last year, many of you know, were some banks who received letters, some of them had soft messages on managing CD ratio. But what is important to note is that when credit growth has been running ahead of deposit growth, maybe in the short term it was good, but at an industry level, there was a need to make sure that it was under check. For federal, you all know we have always been operating at the 80s level, probably 80 to 82, 83 levels. And our philosophy of fund before lend is something which we have tried to maintain throughout. Financial innovation is a space which again is seeing a lot of action, not just from the private players of fintech, but RBI in its own way. RBI Innovation Hub is driving a lot of financial innovation. And the recent one has been on mule accounts. We partner with RBI Hedge closely in all the pilots, and we do see a lot of things coming out of this space on the RBI Hedge innovation, including the industry, other players in the industry. Liquidity and ALM management on the LCR is again another thing where we saw regulatory guidelines coming out, and then which was later subsequently, I'll cover that towards the end, where certain things have been deferred to next year. Unsecured retail lending, this was the one which was the first kind of area where the regulator put a kind of saying that growth is very fast, probably money is getting channeled into equity markets and other places. So this was, I think, November 23 was the time when they asked banks to slow down on the unsecured retail lending space. Credit flow to MSME, again emphasized in the budget as well by the government. This is a space where falls quite well into our, we want to be the SME bank of choice. So plays in quite well into our strengths, and this is an area which we will emphasize, as you will see going forward. Cyber security and digital. I don't know how many of you remember 19th of July 2024. Something very important happened. It was the CrowdStrike, and Microsoft had a global outage. It brought the entire industry down on its knees, and the impact which it had. And subsequent to that, whilst RBI was already quite on top of it, the emphasis which is there to invest in IT security, cyber, is only going to go up. And we, if you recollect our messages in the past as well, investments in control functions, in IT, audit, compliance, cyber security is non-negotiable. It's a zero tolerance area for the bank, and we'll continue to invest. So are other banks. But this is something which we will continue to see investments as we go along. The last one is what I covered in terms of strengthening the assurance functions. And all regulators, it's not just RBI. There are so many other regulators who are coming into play in terms of strengthening governance. And the latest one being NFRA, NAFRA through ICAI, are also trying to make sure that the governance standards, audit standards, everything are maintained at international levels. There is also a move by the government to try and bring down the reliance on global cloud and data centers. So government is working with certain players doing a pilot on having their own data center. And it's only a matter of time when we'll see that will get launched. Probably banks will be nudged to move towards that. And the last part of the slide at the bottom are those points where the first 3 points have been deferred. In the last policy meeting they mentioned till next year, April. And the potential refinements on overlaps between group entities is something where banks have responded, those impacted entities have responded to the regulator. We'll now quickly move to how Federal Bank has performed in terms of last strategy meet and now. When I said last, like I said, FY20, because of COVID, there was a 1-year break. So in 23, we had a meeting to take stock of where we are. And the reference point is FY20 to FY24. We had a CAGR growth of about 14.5% on advances and very closely followed by deposits around 13.6. So the endeavor to make sure that the deposit growth kept pace was pretty much evident. We had seen improvements in all the parameters, and the targets which we had set at that time were met, including the ROA, ROE targets. And more importantly, our risk appetite continued to be moderately conservative, and the asset quality continues to be pristine, because these are things which is the pride of Federal, and we are not known to be taking too aggressive bets on any particular sector. We will continue to maintain that as we go along. This is in terms of the momentum over the 4 years, in terms of CAGR, both on NII, if you see, we had a CAGR of 15.7%. And fee income of 13.6. Typically, I'm sure you remember this message, which has been reiterated. We would like the NII to grow faster than the credit growth, fee income to grow faster than the NII. Whilst the fee, there's still room for us, and there's a lot of opportunity to grow the fee income, which you'll see in subsequent slides when Manian comes up and talks about the strategy for the next 3 to 5 years. What it shows is the opportunity for us to perform within the same risk appetite is enormous. And how we plan to tap into that is something which you'll get to see. At an OP level, the CAGR was only 12.7. There was investment in new branches, investment in technology, and tech spends in FY20 was less than 4% of the OPEX. Last year, we ended at 6.8%. And the plan is it will go up to around 7.5% as we go forward in the next 3 to 5 years. So this is an area which we'll continue to see. And as you all know, technology is evolving, changing so rapidly that what we do now after 3 years becomes irrelevant. We may have to then redo the whole thing. So with that as the backdrop on the economy, the banking industry, and how Federal has fared till FY24, I'll now request Manian to come over and take us through the next leg of Federal's journey. Thank you.